Hello from Core Wealth at the end of the first quarter of 2023. We're going to have a look at the month of March, what happened in financial markets around the world, and then we'll be sharing some of our thoughts as we look ahead and some of the things that we expect to have impact on markets into the future. One of the things that made big headlines during the month was a small bank in America called Silicon Valley Bank. It basically ran out of money to pay back its depositors. The US government had to step in to support it. But there was a lot of uncertainty and turmoil created because of this, and an expectation that this could be the next global financial crisis. At the same time, in Europe, you had Credit Suisse essentially going out of business, although this was not a new problem. It's been coming for a number of months, and it was eventually bought out by one of its largest competitors, UBS. So it wasn't the next global financial crisis. The other thing that remains in the headlines is inflation. In the US, they increased interest rates by 0.25%, and in Europe, or in the UK rather, they are going to have to continue to raise interest rates there as their inflation came out at 6.7% during March. So quite a few points in the newsreel regarding South Africa. First one being that the Purchasing Managers Index dropped during the month, just showing that manufacturing activity had reduced because of load shedding. The second one, also quite a negative point, is that the Bureau of Economic Research does a survey on consumer confidence, and that was down for the month to, in fact, its third lowest level since 1994. So really the consumer taking a bit of a battering. And then we had the Reserve Bank governor pushing up interest rates by 0.25%. Now, would be negative for anybody who has debt, but a good thing in terms of Reserve Bank credibility. They do need to get on top of inflation, and this is exactly what they've done. Some good news was that if we look back over the last financial year for the government, that tax revenues were up 7.5%. This is positive, enabling them to pay down their debt. And I'll chat a little bit more about that a bit later on. The last thing during the month was the call by the political party, the EFF, to the electorate to shut down the economy on the Monday of the long weekend. By all accounts, this was not well adhered to, and we hope that this is a sign of good things to come in future, where the electorate is making sensible decisions around how they vote and what they expect of the political parties that they vote for. So March was a very volatile month, but at the end of March, the result was that the global listed property market was the worst performing place to have been, and secondly, the South African listed property market. This was on the back of the turmoil and the concern created around the banking crises that I spoke about earlier. Other markets internationally, equities were down just under 1%, in South Africa just over 1% for the month. And then if we have a look at currencies, the South African rand during the month actually strengthened against the major currencies. So if we have a look at the longer term, and specifically you'll see I'll highlight the 3-year period here. It's been interesting. 3 years ago was basically the start of COVID, and over that 3-year period, the best place to have been invested has been the South African Johannesburg Stock Exchange. Global developed markets still giving you an excellent return of just over 16%, but compared to 24%, the JSE definitely rewarding investors well over that period. Again, this just highlights there will be different periods of under and outperformance, but the long-term strategies are most vital, and that's something we were saying back in 2020. You can go and have a look at the video back then. But investors have been rewarded for sticking with growth assets, whether it's been the local equity market or the global equity market. Those have been the places to be over the longer term. So here we have the usual slide showing how our strategies performed based on the market conditions we've just shown. And you can see for the month of March that most of our strategies actually underperformed their peer groups just for the month. And that was basically some exposure to property that hurt, as well as more valuation-driven strategies that didn't help during the month. However, if we look over the last year, you can see over 1, 3, and since inception, the relative performance blocks all in green, showing that we've outperformed. And those figures are actually, especially over the 1 and 3 year periods, healthily and quite strong outperformance against our competitors. So something we're very happy with. We're not concerned with the positioning of the portfolios. We still feel happy with our longer term positioning and expect the outperformance to continue to persist through time. So here's the same thing, just looking at our US strategies. And we can see that for the month of March, also a good month, some outperformance of peers. And then if we look both at the 1 year, even though the returns in dollars are negative, still outperforming our competitors between 1.4 and 1.7% per annum. And then the 3-year numbers and the longer term numbers, which are heading now towards a 7-year track record, looking quite strong there, generating some consistent outperformance, which is really what we're aiming for over the longer term. And lastly, our newest strategy, it's our global strategy, but denominated in sterling or British pounds. And you can see here that for the month of March, some slight underperformance by our defensive and balanced strategies, but over the longer term, the last year, some strong outperformance of the peer groups by all of the strategies. And since inception, which was November 2021, all the strategies outperforming on a relative basis, even though the absolute returns are negative. So our international strategies continue to do very well for our clients who are either based internationally or South African clients who have hard currency portfolios that we are managing on their behalf. A key part of our job is to understand where we are going to see growth that will affect both economies and companies that we invest in. Electricity is a big question in South Africa. This slide shows a few things. On the left, we've got a graph showing that the South African economy today uses some 35% less electricity than it did in the year 2000. So it's far less electricity intensive than it used to be. At the same time, we've also listed a number of the projects that are either completed or underway in terms of creating more electricity for South Africa. And you can see that if you think South Africa is around a 45 gigawatt economy, that's the amount of electricity that we need. You can see significant additions, either permanent and some of them temporary, to provide that electricity. So looking ahead, we actually think we're going to see less and less load shedding happening in South Africa. In the short term, there will be challenges, but as some of these big projects come on stream, it's going to be less and less of an issue. And we're not going to be reliant on Eskom, which is definitely failing. But the private sector is taking a lot of this initiative into its own hands, whether that's individuals or companies, to solve it for the future. So one of the areas in terms of the South African economy that's improved has been how the government has been handling its budget. In 2019, this graph shows you that we expected the government wage bill to be some 150 billion rand higher than what it's turned out to be. Now, this is a vast improvement, and important that we continue to see this happening. But we do have to give credit where credit is due, and that's a very good improvement over the last 3 years or so. Internationally, we remain concerned that the US economy is still too strong. And that will then continue to push up inflation, which the Federal Reserve will have to fight. And this graph here just shows you how some of the sectors are really strong, and you can see the last bar in each of those bar graphs up quite strongly, and that we think will continue to fuel higher prices, and which should mean that the Federal Reserve will have to hike interest rates to slow things down even further. So price earnings ratios are a way to show whether a company is expensive or cheap. Lower price earnings ratio, cheaper price you're paying for it. This graph just shows you the levels of price earnings ratio at certain bands of inflation. And you can see the lower the inflation, so further to the left, the higher the price earnings ratio. The S&P 500, the large caps in the US, is currently trading at around 18 times. That's normally when inflation is between 0 and 2%. However, at the moment, inflation is somewhere around 6%, possibly going into the 6 to 8% band, which would tell you that currently on this basis, the American large cap market is way too expensive, probably north of 20% too expensive. And this is one of the concerns we have about equities in the US. This graph just shows you the percentage of banks that are tightening their controls when lending money to companies. And what you can see from the graph is that at the higher levels, this amount of tightening usually coincides with a recession. And we've seen that level spike up quite sharply over the last year. And so we think this could be a further leading indicator that we'll see the US slow down towards the end of this year. So reserve banks try to control inflation by either raising interest rates to slow the economy down and let prices fall, or by dropping interest rates to stimulate an economy. The Federal Reserve in the US is very closely watched in this regard. Inflation has got out of control in the US, but this dot plot just shows you how those members of that committee are thinking, and the purple dots are their consensus view, and then the red dot is what the market is thinking. And what you can see is in 2023, the consensus for the committee, the Fed committee, is that interest rates will get to just over 5%. The market's thinking that it's not even going to get to 4.5%. Similarly, in 2024, the market is expecting rates to come down to 3%, whereas the committee is saying that they'll come down to just over 4%. So that discrepancy for us is a concern. We think the market is being over optimistic and that interest rates will actually have to go higher as the Fed committee is predicting. That we think will further slow down the US economy. It will bring inflation under control, but the US stock market will probably fall from these levels because of this if the Fed does raise rates as much as they're expecting. So March was quite a tumultuous month, lots of ups and downs during the month, but ended the month actually relatively flat, slightly negative. However, the important point is probably those longer term numbers that we showed in the portfolios earlier, that you stick to your strategies, that you've agreed with your financial advisor, and you will be rewarded in the long term. If you have questions in that regard, please give us a call, or if you've got someone that you'd like to refer to us, please do so. But thanks for watching, and we'll see you around.